On one side of the screen, an investor is anxiously glued to their phone as charts plummet. On the other, a different investor sips their coffee, calm and confident. What separates them? It's not a secret stock tip or a crystal ball. It's one powerful word: diversification. If you've ever felt the stomach-churning anxiety of market swings, this video is your blueprint for building a financial fortress. I'm your name, and for the past X years, I've helped people just like you move from financial uncertainty to confident investing. Today, we're going to build that confidence, one block at a time. So, what is diversification, really? Imagine trying to build a house on a single wobbly pillar. Any small shake, and the whole thing comes crashing down. That's what investing in just one thing is like. Now imagine building that same house on a solid, wide foundation made of many strong pillars. It can withstand storms, earthquakes, you name it. It's a diversified portfolio. The old saying is don't put all your eggs in one basket. But in modern investing, it's about more than just protecting your eggs. It's about turning those baskets into a fortress that generates multiple streams of potential growth. Let's look at the data. During the major market downturns of 2008, 2020, and even the recent volatility, diversified portfolios consistently cushioned the fall and recovered more steadily than concentrated ones. The proof is right here. This isn't just a theory. It's a historically validated strategy for long-term success. It's about playing the long game, not just reacting to today's headlines. All right, let's get to the fun part, the building blocks of your fortress. Think of these as the different essential materials you need to construct a resilient portfolio. Our first block is asset classes. This is the most fundamental layer of diversification. We're talking about stocks, which are ownership stakes in companies and offer high growth potential but come with higher risk. Then there are bonds, which are essentially loans to governments or corporations, typically offering more stability and predictable income. Next up is real estate, which can provide rental income and appreciation. Then you have commodities like gold or oil, which often move differently than stocks and bonds. And finally, cash or cash equivalents, your safety net for liquidity and opportunities. See this heat map? It shows how these different assets rarely move in perfect sync. When one is down, another is often up, creating a smoother ride for your overall investment journey. Our second building block is geographic diversification. It's easy to fall into home country bias, where you only invest in companies in your own country. But look at this. The US stock market is only a piece of the global pie. By ignoring the rest of the world, you're missing out on massive growth opportunities. We can break the world down into developed markets, like Europe and Japan, which are stable and mature, and emerging markets, like parts of Asia and South America, which offer higher growth potential, but come with more risk. Spreading your investments across the globe is like having teams working for you in different time zones. One is always active. Next, we have block number 3, sector diversification. Even within a single country stock market, you don't want to bet on just one industry. Remember the dot-com bubble? Investors who were all in on tech stocks got wiped out. Healthy portfolio spreads investments across various sectors, like technology, healthcare, finance, energy, consumer staples, and more. Each sector has its own economic cycle. When interest rates rise, financial stocks might do well. When the economy is slow, consumer staples, the things we always need, tend to hold up. This pie chart shows the 11 major stock market sectors. Your goal is to own a slice of as many as possible to avoid being overexposed to the fortunes of a single industry. Our fourth and final core building block is time diversification. This is one of the most powerful and underrated concepts. It's called dollar cost averaging. Instead of trying to time the market by investing a huge lump sum at the perfect moment, which is nearly impossible, you invest a fixed amount of money at regular intervals, say every month. Look at this animation. When the market is high, your fixed investment buys fewer shares. But when the market dips, that same amount of money buys more shares. Over time, this strategy averages out your purchase price and reduces the risk of investing everything at a peak. This disciplined approach, combined with the magic of compound interest where your earnings start generating their own earnings, is what creates that incredible exponential growth curve you see here. It's about consistency, not timing. Now that we understand the what and why, let's build your practical blueprint. This is your step-by-step guide to making diversification a reality. Step 1 is crucial. Assess your risk tolerance. Are you a conservative investor who prioritizes protecting your capital? A moderate investor who wants a balance of growth and safety? Or an aggressive investor willing to take on more risk for potentially higher returns? There's no right or wrong answer, it's about what lets you sleep at night. Here are some sample allocations for each profile. As you can see, the conservative portfolio has more bonds, while the aggressive one is heavier on stocks. Be honest with yourself here. It's the foundation of your entire strategy. Step 2 is choosing your strategy. How will you actually buy and manage these building blocks? You have a few great options. The first is the DIY approach. You open a brokerage account and handpick your own stocks and funds. This gives you maximum control, but requires the most research. The second approach is using index funds or ETFs. These are fantastic for beginners. One fund can give you instant diversification across hundreds or even thousands of stocks, like the entire S&P 500. It's simple and low cost. The third option is using a robo-advisor. These platforms use algorithms to build and manage a diversified portfolio for you based on your risk tolerance. Even handle rebalancing automatically. Each has its pros and cons. So choose the path that best fits your time, knowledge, and interest level. And that brings us to step 3, your implementation timeline. Don't get overwhelmed. You can do this systematically. Here's a 90-day action plan. In the first 30 days, focus on education and choosing your strategy. In the next 30, open your account and make your initial investments according to your target allocation. In the final 30, set up your automatic contributions for dollar cost averaging. From there, it's about maintenance. Set a calendar reminder to rebalance your portfolio once or twice a year. This means selling some of your winners that have grown to large and buying more of your underperformers to get back to your target allocation. This disciplined process ensures your portfolio doesn't drift away from your intended strategy. You can even use techniques like tax loss harvesting to improve your efficiency. Over time, you'll see your portfolio evolve from a single seed into a mighty, diversified forest. Before we wrap up, let's quickly cover the common mistakes to avoid. First, over-diversification, or as some call it, deworsification. Owning 20 different tech funds isn't true diversification. It's just complexity. Second, chasing performance. Piling into last year's hottest stock or fund is often a recipe for buying high and selling low. Third, ignoring fees. High fees can eat away at your returns over time, so always be mindful of costs. Fourth, making emotional decisions. Panic selling during a downturn is the single biggest destroyer of wealth. And finally, forgetting to rebalance. Your portfolio needs regular checkups to stay healthy. Avoid these pitfalls, and you're already way ahead of the game.
So let's recap. We started by understanding that diversification is about building a resilient financial fortress, not just a wobbly pillar. We explored the 4 key building blocks: asset classes, geography, sectors, and time.
We then laid out a practical 3-step blueprint to assess your risk, choose a strategy, and implement it with a clear timeline. Building a diversified portfolio isn't about achieving perfection or timing the market. It's about protection, patience, and the powerful peace of mind that comes from knowing you're prepared for whatever comes your way. It is the steady, disciplined path to long-term wealth. Thank you so much for investing your time with me today. I hope you feel empowered to take control of your financial future. If you found this helpful, please give this video a thumbs up. And do not forget to subscribe and hit that notification bell so you do not miss our next video on advanced investment strategies. Until next time, invest wisely and stay confident.